election is defined as 10%, and I don't say we've kind of seen that in the S&P. It's not official. If it went down another 400 points, there would be a lot more buying, right?
I think we're in purgatory with the
What you're seeing is a lot of unwinding from after the election.
markets. We got a new administration coming in. It's a big wait and see kind of month.
Should you always be buying? That's actually a question I think a lot of people are asking. Remember a couple of years ago, we had the TINA trade. There is no alternative. Now, yields are starting to get a little bit elevated. Remember all that money in the money markets right now? Just check, 6.85 trillion. Everybody said that's going to come out. That's going to be a big tailwind for the market. But it's actually grown over the last year despite the rally. In your mind, is staying in cash, staying in bonds, staying in money markets, is that more attractive than the market, the stock market right now because of the volatility?
For long-term investors, no. If you're investing over the long term, you're going to be begging for today's prices 10, 20 years from now, right? Whether it's a
And that's true. If you, let's say you retired in the end of 2021, or no, let's say this. You retired at the end of, let's just say 2021, right? And you started converting your money into the fixed income market, and your advisor was smart enough to say, let's get you in some short-term debt securities. You would have been extremely happy, right? You would have had more money than you planned on. And that's what's kind of going on right now. The yields are extremely high, but I think that they are going to go up. And I hate to sound like a broken record with this, but it's the amount of treasuries that are coming due. It's going to be painful for the U.S. if our debt is just going to increase. And they're going to have to sweeten those interest rates. They're going to have to sweeten those interest rates if you want to have liquidity during those auctions, right?
home or the stock market.
But even if you're a long-term investor, don't you need to make short-term moves, changes to your portfolio? I mean, even if you're planning for the next 30 years, you got a 30-year horizon, don't you want to get in and out of some sectors or some areas just that are showing some weakness right now and maybe put money back in there later?
At the very least, a rebalance here at the front end of the year might be a good move, right? You've probably baked in some risk from outperformance of that.
But a lot of the rebalancing is going on right now is due to, people didn't want to get the tax hit by selling at the end of the year, so they're selling right now, and there's a lot of readjusting. And then there's the volatility again with the 10-year going up, as well as some of these Fed scares when they're talking about the inflation, or if they're going to cut rates by 25 basis points next meeting. So there's a little bit of volatility, and that's due to the kind of the uncertainty right now. It could be a buying opportunity. I wouldn't just run to the bank and say buy right now, but you definitely want a dollar cost average because you don't know which way the market's going to go.
The equity is from 23 and 24, so you're heavy on those equities. You can cycle out to your fixed income positions or other areas that have lagged the Mag 7 or large caps of the world.
All right, speaking of the Mag 7, I want to ask you about this. This is a question I think a lot of people are trying to figure out.
Top 7 of the S&P.
Are they growth stocks? Is that the AI narrative that's going to push the market higher, or are they defensive stocks? They could be both, I guess. But I want to look at the Mag 7 over the last month. I'm just kind of using the last month because that's when we started to see some of the weakness in the market. The Mag 7's up 3%. The market's down 3%. So what are the Mag 7 in your mind? Are you worried about the narrowness of the market? Are you worried about over concentration? Or should we just be loading up on these because they just continue to work?
Yeah, they do continue to work now, don't they? Now, whether they're defensive, I chuckle a little bit, but they're saying that because of stability in earnings. You got basically dominance in the market. However, you don't have to go too far back in time to 2022 to see, what happened to technology, and some of those Mag 7 stocks overall is pretty.
But that's kind of a silly argument, right? Because the reason why they went down in 2022 is because interest rates went up, right? So whenever you get 1% of interest rates increase, the S&P, for example, the market cap goes down 10%, right? And that compounds, right? So Interest rates go up, it compounds another 10%, and then 10% of that, and then 10% of that, and 10% of that. So that's a crappy analogy to give in what's going on right now, whether decreasing, right?
Pretty brutal out there. So I still view them as growth. If you're doing the AI play, you definitely are speaking to growth there, but they're strong. There's no doubt about that.
So I know you're always talking to the long-term investor. I know you're always talking about the long-term investor, but I want to ask you about some of the change in leadership we've seen to start the year. Energy being the leader, consumer discretionary being the laggard. It was consumer discretionary. It was one of the big winners last year. Should you maybe be allocating towards energy? Do you see a big rebound in energy this year? Oil prices rising as well. Should you maybe be putting money in healthcare after it had a really tough year last year? Is now the time to...
And it depends on what kind of oil you want to go into. So during the Trump administration last time, right, oil decreased. Oil prices decreased. So people were buying like B&O and they didn't know what they were doing, right? A better, smarter play would be to buy some of the utility companies, some of the companies that do that fix the oil rigs or do surveying. That would be a smarter play, right?
Put some money in some of those laggards, or again, just keep riding the wave.
I view there being no issues with having a slice of your portfolio in sectors that you feel strongly about.
How big of a slice, though?
Talking 5% up to 10%.
So a very small slice.
Yeah, we're not talking, very large allocations to the hunches you have around sectors that you believe will perform well. But that 5% allocation to see if, your thinking's right, it's not necessarily a bad idea, but we're largely broad-based investors.
Let me put you on the spot. That 5% you're talking about, where would you put it? Would it be healthcare? Would it be energy? Could it be small caps that are almost in correction right now? Where would you put it for the hopes of a big rebound in 2025?
That's a really great question. I come on here, I like digital assets. I still think there's an opportunity there, but I like energy. You've been talking about it. I think
I would disagree, but whatever.
There's opportunity. If we do see rising oil prices, you're going to see appreciation out of the energy sector.